if you're there, Randy, and you wanted to say a couple words, go ahead.
I do, and thank you, Justin. The reason I like Justin and the reason I like day trade the markets is that Justin's a regular guy. He's like the stories of practically every trader you've heard where they've gone through, they've not been doing well, and all this stuff, and he spent some time in that purgatory, that trading purgatory, and Justin found a way out of that. Okay, and out of that, I think he has a story and a method to really talk about for and to give hope to traders who are sitting there going, it's something, all this information, but how do I take my past experience and how do I start building it into a positive future where I become a consistently profitable trader? Well, Justin has done that, okay? And out of that, that's where I find the great power of what he and Dave do. And Justin's the pitch man. He's the guy that talks, but he's also the guy that came and had to learn to become a good trader. He didn't land out of nowhere. So what I want to do is welcome Justin, and I'm going to have you take over, and I'm all ears.
Thank you very much, Randy. I really appreciate those words very much, and also thank you to everyone who is taking an hour out of your day to attend. Really appreciate it. I've got a lot of slides. I'll go through them and try to make as good a sense as I can of this. Let me give you a little bit of an overview of what we're going to do. Let me tell you briefly about my story. Randy touched on that. Talk about the 12 components that every trader really has to have, in my opinion, as part of their trading plan, and then I want to tell you about an idea that I call box theory and how we can then score trades on a scale of 1 to 10. I think that a lot of people find pretty interesting. So again, that's the idea. You can see kind of some boxes on the top of the slide here. Then come trade setups that we can score and make sense of. So I'll talk a lot more in depth about that. But real quickly about me, as Randy mentioned earlier, I started trading around the year 2000, thought I had it all figured out, and quickly lost my account. Did that about 3 or 4, probably about 5 more times in the next 7 or 8 years. Very similar path to a lot of people. I just seem to want more punishment, I suppose. But luckily, I was able to find. I decided to stop doing it the way I'd been doing it, and I found a mentor, Dave, who's been my partner. I started working with him in around 2007 or 8. Really was the catalyst for everything, turned everything around, really made me think about trading in the markets a lot differently. And in that time, then Dave and I created a software package, and we've been offering that to other traders in the meantime since around 2010 or 11, I believe. And what's going to happen here shortly is Dave is going to be semi-retiring, and so I've got a choice to either shut the business down or really take it and run with it in a slightly different direction. And so that's what I decided to do after some deliberation. And I'm going to tell you about some of the shifts we're going to be making, and it's going to be very, very, very soon. Basically the gist of it, this idea is that kind of on my own, I've taken our tool and created these idea of boxes and really came up with my own methodology. And in 2016, then a few people asked me to do some one-on-one coaching, which I did, and I decided to do that for them. And it was a very intense program, but taught them this exact method that I'll be kind of touching on and talking about today. It went very well, better than I even would have expected. People had great things, really felt like they saw the market more clearly than they've ever done before. And so decided I'm going to be doing that here going forward. So I'll tell you a little bit about that. And so hang around to the end on that as well. Also, absolutely, we'll have time for questions here at the end. But let's start with this idea of what every trader really needs to have. And I think this is a very common mistake, is that traders tend to focus on entry and exit, mostly strategy. They don't have a full, A to Z trading plan. And it's similar to, it's a diagram of American football here, but most of us, when we look at a football game, we look at the quarterback or the wide receiver, and that's kind of in trading parlance, that'd be more like the, our trade entry and maybe our trade exit. That's what we tend to focus on. But the thing about, trading is you have to have a full plan, and every part works together. If the, left tackle doesn't do its job, this could be the greatest quarterback in the world, but it's not going to be a successful football play. And same thing, you could have the best entry in the world, but if you don't take care of all the other pieces, you're going to be in trouble. So what I wanted to do is kind of talk about, the 12 steps that the 12 components of a trading plan that I really think every trader has to have. And while I'm going through this, you can kind of, either write it down or, just kind of check off in your mind, how many of these do you do? And so the first part is more of a mental thing, but you really have to redefine, and this was a big shift for me going back, 10 years now, redefine how you look at yourself and your job as a trader. You're not really there to make money. You're there to try to make sense of the market and make the best decisions and let the money take care of itself. So redefining how you look at yourself is incredibly important. We talk a lot about that in our training. I'm not going to talk about a lot of that now. You also have to, kind of on the mental side, really have a method and a system for retraining your brain and your behaviors, because just by the nature of this business, our brains, the way we're wired as humans, it's not naturally predisposed for trading success. In fact, most of our kind of natural heuristics or natural wiring go directly in the face of what it takes to be a successful trader. So it's very important that we focus on that part as well. We also then, you really have to understand how the market really works. It's really foundational. It's fundamental for everything. You have to understand why the market goes up, why it goes down, why it consolidates, why it goes into a vertical phase. This, you have to know this first. And it's very similar. You can look at these two images here and intuitively you know that when you're driving, the different conditions require different strategies. The road on the left, you can go fast and don't have to worry about it. The road on the right, you better not go fast. You're going to go off the side of the mountain. And it's the same thing in trading, but most of us don't understand that. But if you can learn to identify when do we have a, metaphorically speaking, icy, windy road and when do we have smooth sailing, it really makes a huge difference. In fact, I would say that was another one of my biggest turning points that Dave helped me see, was that it's not about your trade entry so much as it's your ability to understand the condition that the market is in. Then you apply your trade strategy from there. You can't do it first. You can't be entry focused. You have to be context focused. The entry then plays into the context that the market has. Additionally, you have to be able to see the underlying market activity. There are different ways that you can see what's going on in your charts. We have a tool called relative aggression bars, which at this point I couldn't imagine trading without. Obviously I'm biased, but I love the tool and it's the basis for everything else. I'm going to talk a little bit more in depth about relative aggression bars in a minute. But the next thing you have to be able to do, once you can see the market, you have to be able to put it into context. The way that I do that, and what I'll be teaching, is an idea called box theory. The way I think about that is each day is you can think of each day, trading day, as a book. Each box would be like a chapter of the book, okay? And so I'll talk again a little bit more in depth about this as well, but the key point is you have to have a way to put the market into context. Then you have to have a dependable, reliable, high edge, high expectancy trade setups, okay? I teach 12 of them. There are a few others that you can have your own, but you have to have trade setups. Again, trade setups are not the most important thing. Context is more important than that, but trade setups, you have to know, you have to have some strategies to get into the market. Then you have to, in my opinion, know when to actually take a trade. You don't want to just blindly, in my opinion, and I'm pretty firm about this, you don't want to just blindly take the trade every time that it sets up. Again, that's being entry focused. You want to be context focused. You want to understand what the opportunity that exists in the market is, and you want to understand how much risk you'd have to take to enter that trade, and you have to determine if that is worth it. So in other words, you've identified a trade setup, but then you have to be able to determine, do you want to take it? Do you want to pass on it? Do you want to be more aggressive on this trade? Do you want to be more conservative? Do you want to step up your position size? Do you want to reduce your position size? A lot of these different factors, but that comes with the ability to understand, and I do this by scoring trades on a scale of 1 to 10, and I'll talk about that as well in more depth. Once you're in a trade, you have to understand and have a plan for managing your trade, more importantly. And again, I think exit is underappreciated, if you will. It really is the difference between the great trader and the good trader. It's the difference between the good trader and the break-even trader. It doesn't get as much attention as entry, but exit really is a big deal. So you have to have a plan, basically, in my opinion, for the loss side and the profit side. So in other words, when you get into a trade, what is your plan for your initial risk? What do you do when the market starts to move against you or move forward for you? Do you have a plan when things start to go poorly or when things start to go well? What happens on the profit side of things? Do you know when it makes more sense to take a quick exit, take a small profit? Do you know when and how you want to go for bigger moves and when the right time is? Do you have, I have what I call a checkpoint. These are incredibly important factors that you need as part of your trading plan. You also then have to be able to manage your account. In other words, how much of your account are you going to put into play on a given trade? Are there situations where you want to take a little bit stronger position? Do you want to take a little bit smaller position at other times? How can you grow your account more effectively? How can you kind of mitigate the damage when you have a rough patch? These are important factors that have to be part of your plan. You then also have to know how to manage your emotional state before you're in a trade, while you're in a trade, when things are going well, when things are going poorly. Being aware and knowing how to manage your emotions, it has to be part of your plan. You also then have to have kind of a step-by-step strategy, procedure, methodology, whatever you want to call it, to kind of put it all together. And this is just kind of a taste, but you really need to know. You can't do this in the heat of the fire. You have to know ahead of time how you're going to react in all of these situations. It has to be logical, and you have to know what triggers what. So you have to know when, which side you want to get on. Do you want to even take a trade? How aggressive do you want to be? What are you going to do if it goes against you? What are you going to do when it goes for you? All of these factors come into play, and it needs to be set out. Now, those are the 12 factors that I think that everyone really has to have, and you can think about how in-depth that is part of your plan as of right now. I think one thing that you should have, in my opinion, is a mentor or a guide or a coach. Randy does that on the mental side. I'll tell you about a program I'll be starting up here where I can be your coach for an incredible value. It's the same thing. If the picture on the left there, you want to go whitewater rafting on a really powerful river, I would recommend you have a guide to do that, and it's the same thing here. And the image on the right there, I kind of like that because there's a benefit to me as well. I think there's the back and forth is really incredible. And again, if I wouldn't have taken the leap and gotten a coach going on 10 years ago, I absolutely would not be here today. So I think that's what everyone should do. So again, think about each of those factors. Think about how you put those into play. Do you have areas where you don't have a plan for all of these things? Certainly, I can teach you a plan if you like, but it's important to think about that. So next, I want to kind of delve into each of these individual components to really understand why the market does what it does, and then how we can put it into context, and then how we can come up with some trade ideas, then how we can kind of score them to determine if they're worth taking or not. So the first part I want to talk about is the tool. Some of you may be familiar with this, what we call relative aggression bars, and how they can really help you see what's truly going on in the market. And the reason behind this, or the logic behind this, is that the market literally only moves if one side, either the buyers or the sellers, is collectively, as a whole, more aggressive than the other. If everyone in the market is passive, the market won't move. If collectively buyers are more aggressive, the market's going up. If collectively sellers are more aggressive, the market's going to go down. And it's not so much about there are more buyers than sellers or more sellers than buyers. We know that every time a buy order comes in, there had to be an equal number of contracts on the sell side. So it's really about the aggression. Again, collectively, if buyers are more aggressive, price is going up, and collectively, if sellers are more aggressive, price is going down. I'm not going to now, but a lot of times you can look on the website for some other information about kind of the logic and philosophy behind the aggression bars. But the bottom line here is that aggression is what causes the market to move. So logically speaking, if you can identify and see this aggression as it's happening, you're going to be able to read the market more clearly. The ability to read the market more clearly is going to help you make better trading decisions. The better trading decisions lead to better results. There's no other way to do it. You can't just strive for better results and it happens. You have to take it step by step. The results are kind of a side effect of doing things the right way, if you will. And so really briefly, what are aggression bars? We have a level 1, level 2, and level 3. They're telling you if the market is, collectively or at this moment, relatively speaking, compared to normal, more controlled by is there more buying or selling aggression? Is it moderate? Is it strong? Is it extreme? So it's telling you right now which side, again, buyers or sellers, is more aggressive, and also not just the raw information, but the degree of that buying or selling aggression. Again, especially those level 2 and level 3 bars really matter. They're telling us that something major is happening. It's not just noise. It's not just the normal back and forth, but something major is happening in the market. And if we can see that in real time, time, it gives us a kind of a real-time roadmap. It gives us an advantage. And I like this image here that you can see. If you think about the image on the left, it's looking down on a highway. You can see the cars going north and south, slowing down, speeding up, turning right, turning left. That's in essence like a price chart on the, looking at your price chart. But what would be nice to be able to see is not just what did happen, but what leads what happens. In other words, you can see the cars going, north and south, fast and slow. It would be nice to be able to see, why the car does what it does, and is the accelerator being pushed? Is it being, gently pushed, or is it being, pushed to the floor, right? Same thing. We have an idea called deceleration. It's like the brake idea. Are the brakes being slammed, or the brakes being kind of tapped? It's the idea that, we're not looking at lagging indicators. We're not just looking at price action. We're looking at the aggression, which is getting us under the surface of the market, because it's aggression that leads price. So if we can see what the aggression is telling us, we have a much better ability to see whether the market's going up or the market's going down, and we can follow with that. So with these relative aggression bars, the possibilities really are endless with this. I'll give you a few examples just in generically speaking about how you can use the relative aggression bars. But again, like I mentioned a bit ago, it informs you when something important is happening that you should pay attention to versus when it's just kind of the noise. You can see the area that's circled is just a lot of gray bars, which tell you there's no real buying or selling. Some level 1 bars are in there as well. That's the moderate buying, moderate selling. Those are interesting information, but certainly the strong buying, then it goes kind of sideways, and then some strong to extreme selling comes in. It's that idea that it really shows you when something important worth paying attention is happening. Another way of looking at these is it tells you when, or another way of saying this is how to avoid being on the wrong side of the market. If you did nothing else in your trading career but avoid being on the wrong side of the market more often, it's going to make a huge difference in your P&L. And that's the same idea here in this example. We've got some extreme selling, extreme and strong selling. First half of this chart, you don't want to be on the buy side. You need to wait for something to change. Here you can see about a third of the way in, it's our first sign of buying. We start to get some follow through. The buying is continuing. We take out the selling. Buyers are in control now. It's telling you, things are starting to shift. Early on, don't want to be going against that. You want to be on the short side. Then we can see things are starting to shift. There's a little bit of a battle. Then the buyers take over. You don't want to be on the wrong side of the market there. Same thing on a breakout idea, and I use this a lot on a breakout type trade. You can tell when a market makes a new high or a new low, or you're looking at a key level and it breaks through. If it does that on just a gray bar or a non-aggression type bar, it's more than likely a head fake. If it does that on an extreme selling aggression bar, an extreme buying aggression bar, it's telling you, it's giving you a lot better edge that it's going to be a true breakout. And so it's very powerful in that sense as well. It can also, if you have an area of interest, an area of support or resistance that you're monitoring, and we'll talk about this with boxes as well, it can give you, rather than just sticking a limit order in there, you can wait to see if the buyers or sellers actually show up like you're expecting at that key level, just giving you, again, increasing your edge. It's showing you under the surface that, hey, we kind of grinded lower with these with this moderate selling. Here's our level. Any buying showing up? No. Okay, there's some really good, we make new lows, can't hold there. We get some really good, strong buying aggression that comes in. That's probably our turning point. Is it for sure? We don't know, but we know that it gives us a much greater edge than just, sticking a limit order in there blindly. Another way that you can use these, again, kind of just generically speaking, is, and we have members that just use the aggression bars for this reason, it can help you stay in trades longer or bail out on trades earlier. It's the idea that you got into a trade for a reason. A lot of us, we get into a trade, we start to see it go our way, and I should take my profit, or we start to see it go against us. I better get out before it's a bigger loser. That's, those sort of things. Well, this helps you kind of sit through those things when it makes sense to. If you got, long in this area, just as an example, it's all buying. We have a little bit of quietness, but no selling is showing up. It's a type of thing where you can, ideally, if you want, if this is your style, it helps you hold the trade a little bit longer, so you can wait till you actually see either buying fail or selling start to come in this example. And again, that's just kind of a small sample of what you can do with these aggression bars, generically speaking, and that's what we've been doing for several years, is helping people use these aggression bars to make better sense of the market. But kind of the next level of the business here, the aggression bars play a big role in, and that is in creating this idea of boxes. And so I wanted to just kind of briefly talk about what these boxes are, why they matter, how they can help you make smarter decisions. And so to do that, basically the first question, what are boxes? And they're a strategy that I've personally been using for about 3 years now. Over time, I understood the natural flow of the auction, the natural flow of the market, and I just kind of pieced these things together and came up with this idea of boxes. And took some experimentation, but got it pretty solid. And I had done fine prior to having the boxes, but what I found is these boxes made things just exponentially easier. It made the market so much easier to make sense of, but obviously by extension, if you can make better sense of the market, you can trade it a lot better as well. They were really a major breakthrough for me personally, and like I said, when I taught a few people this in 2016, they felt the same thing. So I really think they're very powerful. And another thing that you can think about is they help you simplify the trading day. It just makes things simpler. Any 30 Rock fans there, we see a Liz Lemon shotgunning a pizza on the left, but the idea here is, you don't, generally speaking, pick up a pizza and stuff the whole thing in your mouth. You cut it into smaller pieces. It makes it a lot more effective, less messy, more digestible, just easier to work with. And that's the same idea with boxes. Another way of saying that is it kind of changes the boundaries, if you will, of the playing field. So you can see here on the picture on the left is up in Minnesota, I believe. They have a big pond hockey tournament. That's kind of our big picture, the day as a whole, right? This lake. Now, each of these on that lake, they've broken that down into several different hockey rinks. That's kind of our boxes. That's our playing field. And then once we get within a box, that's the image on the right, that's where we make our trading decisions. We're IDing trades, we're scoring trade opportunities, we're managing our trades based on how they behave in the box. So it's kind of breaking it down from this big day into a smaller piece that we can work with, which is the box, and then we can make a lot better sense of what's going on. And I like to say this idea of kind of win the box. In other words, make the best within each box. We want to make the best possible decision we can, like I said, in that box. That might be to take a trade. It might be to pass and wait for another box and wait for more evidence. But we're trying to, instead of trying to make a huge decision with the whole day at stake, we're trying to just make the best decision we can within that box and let it kind of add up as the day goes by. So another way that these boxes help you is in making sense of the structure of the day, helping you put the market in context, helping you determine what the quality of the opportunity is. And there's kind of two ways you can do that. The first one is more of a macro way where, the image on the right is we call micro. That's all, I guess I must have been hungry when I put these slides together, the pizza and the hamburger here. But each of these pieces of the hamburger is one box. They put them all together, we can make sense of it. That's kind of the day as a whole. And so I'll talk first about kind of the macro level of boxes, because the market, if you can learn to kind of read, the market's always telling a story. And if you know how to read it, if you can tell the narrative, it really makes an incredible difference. And so, are buyers in control? Are sellers in control? Are we having a trend day? Are we having a consolidation day? Is the market reversing? Is it probing a certain area? The boxes are going to give you signatures on these different concepts. And briefly speaking, I mean, here's an example of, you can see that we have stacking buying boxes, just buying box, buying box, buying box. That's telling you this is a one-sided market. This is a buyer-controlled market, okay? This is telling you when these boxes are stacking that this is essentially a trend day. It means buyers are in control until conditions change. You do not want to try to be a hero and try to pick the highs here. Okay, when it is time to possibly step in and be aggressive to the sell side, the evidence will tell you that. The box signature will change, but don't try to fight that. So many people, want to be the hero. They want to pick off the high tick there, and it's just when you have a trend day like this, a box where boxes are stacking, this is one-sided buyer control. You don't want to fight this, okay? You do, however, want to take long trades. We want to, the long trades we can identify, we're probably going to want to take those. We want to be probably more aggressive versus being less aggressive on our entry. We want to ideally look for a way to hold for a larger profit instead of taking a quick one. And so the box signature itself can help. And you can see the same thing here. This is the same thing in the other direction. This is a one-sided seller-controlled market. We have selling boxes that are stacking. We're having a trend day down. You don't want to try to be a hero and buy the low tick on this. The evidence will show up when it's time. What it does mean is sellers are in control until conditions change. You want to, if we identify a short trade, you want to probably take that. You want to be a little bit more aggressive on your entry as opposed to being too conservative, and you want to try to plan for a larger profit if it develops. But that's the plan going into a trade on a day like this. Now compare that to a day like this where this is what I call a two-sided market where both sides are in play. You can see there's no stacking. The selling doesn't have follow through. The buying box doesn't have follow through. It's just a consolidating, horizontal type day. What does that mean? It means you have to change your strategy. You either need to stand aside, or rather than looking for go with type trades, you need to be looking for fade or reversal trades. In other words, you need to be looking to be buying the lows of boxes and selling the highs of boxes. We want to be a lot more conservative on our entries. We want to take as conservative and nimble a entry as we can. We want to, again, be willing to fade the market. We want to think point to point on exit as opposed to going for a bigger move. If we get in at the low of a buying box, we probably want to get out toward the high of it. It's the same idea. You don't want to get impatient. You don't want to force things. You don't want to be too aggressive. You don't want to expect or go for a huge winner. You have to know how to read the market. The boxes really do a great job of showing you that. Here's another quick example where you can see the market starting to reverse. We have stacking buying boxes, then you can start to see sellers show up. The buying box fails, the selling box has follow through. We start to then stack to the selling side. So you can just see a reversal develop as well. So that, again, looking at how the boxes interrelate with each other is more looking at them on a macro level. The micro level is how does the market behave within each individual box. Now each individual box makes up the day as a whole, a macro, but it's important. So we kind of look at this, like I said, in two different ways. But the micro level, let's just say generically speaking, we have a buying box that shows up. What that means is that essentially should be it should constrain the market. It should be kind of the boundary where we trade in between when we have a buying box like that. But we certainly, when we have a buying box, we would expect that if buyers are legitimate, which they appear to be, we would expect the lower portion, the lower 15-20% of the box to hold and offer support, and then for it to test back up to the high of the box. Now, if buyers are very strong, they'll be able to break through, gain what we call acceptance above the first box, and if they're very strong, they'll even be able to create another box, and we start to stack. And then again, the logic repeats. The low of this box should hold. It should constrain the market within this box, and if it's really strong, we'll go make another new high. And it's the kind of, again, breaking down each box as we see it come in. Now, in this case, or in a different case, let's say that the buying box tests the low, we find support like we would expect, and we test the high, but rather than having that acceptance above where the buyers are very strong, instead we just test the high and we come back in. Well, that means that either, that's what I call a red flag at times, and that means that either this is where sellers are going to take back over the market, or it just shows us that we are constraining this market in this box, and we're going to come back down and test the low. Are we going to bounce again and retest the high, or are we going to accept below there? And that's kind of, we again just try to make sense of each box with the behavior of the market, with the expectation, and does it live up to the expectation? Now here's an example where it wouldn't have lived up to the expectation, where we have a buying box, but instead of holding support where it would be expected, the buyers are weak or the sellers are strong, and we start to accept price below the buying box. And if sellers are very strong, they're going to create their own selling box, okay? And then we would expect the high of that to hold with some resistance and then test the low. And it's just a way that we can kind of go through our day making sense of the relative strength, the relative weakness of buyers or sellers. And again, this is generically speaking, but we get into a lot more depth with this, but that's the idea behind it. And again, this is just a few generic, brief, tip of the iceberg examples. The bottom line is that if you use boxes and learn how to make sense of them, which is what I'll be teaching, you're plain going to see the market more clearly. It's going to make more sense, and you can trade with more confidence. And the nice thing about the boxes is that's just kind of the starting point. That alone is really good information, just like the aggression bars that help build the boxes alone are really good information. But what we can then do is take the boxes and create different trade entry setups. And so let me talk about that now. So I have about 12 different setups that I use. I don't necessarily use them all, but I have the option to use them, I guess you could say. And what basically I do is the first 4 trades or so are kind of the basic ones that I would recommend learning at first, and then we can get a lot more advanced with these. But the first one, the first and third, fourth trade here are relatively simple to understand. So I just wanted to talk briefly about those, that idea. The first one, again, the simplest, the most common trade. In theory, you could have, anytime there's a box, you could, in theory, try for a retracement trade. Again, you wouldn't want to, because we'll talk about scoring in a moment, but that's in theory, just generically speaking. If you have a buying box, we would expect the low of that box to hold. Therefore, it's a pretty good place to enter a long trade. So if we have evidence that's, that we'll talk about shortly, that supports that, that's a pretty good spot to be getting into a trade. So again, buying box forms, look to just get into the market in the lower 15-20% of that box. Very low risk, because our stop's going to be a little bit below the box. Very high expectancy. You can see an example of a box here where you're looking to buy the low, just called a retracement trade. Same thing here. This is on the sell side, the selling retracement trade, where we have a selling box. We would expect a retracement back to the high of that selling box. That should offer us some resistance. We know that it's a very small risk type trade, because our stop can be just a few ticks above the high of that box. This is a low risk, pretty high expectation type trade, especially when you put other pieces of evidence in there together. So again, you can see a selling box, waiting for it to retrace up to the high of the box, and we sell it up there. Just the basic trades. Now, there is a more aggressive version of this retracement trade, where again, we'll talk about scoring, when the score dictates that it might make sense to be more aggressive. So rather than waiting for a buying box to form and then waiting for a retracement all the way down to the low of the box, there are cases where it makes sense to get in toward the middle of the box. Yeah, the risk is a little bit greater, but the opportunity, the score is so high that it makes sense to just jump on board and be more aggressive, as opposed to, the risk in a sense is almost missing out. The opportunity is so good that you're better off being more aggressive on the entry rather than missing out with a very conservative entry. Okay, so that's the idea. Same thing here on the sell side. This is just a retracement trade, more aggressive version. So rather than waiting for a full retracement back to the high of the box, there are certain situations, certain scores where it makes sense to just jump on board toward the middle of the box. Yes, it's a little bit more risk, but the opportunity is so great that it justifies taking a little bit more risk on that type of a trade. Here's another simple, very common trade. This is what I call the acceptance pullback. So it's the same idea, where we have a buying box, and whether you took a trade, a retracement trade on this one or not, eventually the market is showing, the buyers are showing that they're strong enough to accept. They've broken out of the constraint. They've broken out of the containment box, right? And now they've accepted price above the box. Well, one way that you can do that is, if once the market has proven that it's comfortable up here, then what was once potentially resistance should now flip over and be support. So we can wait for it to retrace back down to the high of the box and get long from there. Same idea here. We have a buying box. We accept price above it. When it retraces back down to the high of the box, that should be very good trade entry. Again, very low risk, because our stop can be just a few ticks below the low of this, the high of this box in this case. Okay. Same thing here on the flip side, the acceptance pullback trade short. So, selling box, we accept price. Sellers are strong enough to get comfortable below the box. Therefore, what was at one time potentially support turns over, flips into being potentially some resistance, and it gives us a nice pullback. So the acceptance pullback trade, this one on the short side. This one is what I call the combo trade, or the overlap trade. It's kind of again, a combination of the two I just talked about. So if we look at this box, the first buying box here, we'll call that buying box 1. And then the next one we'll call buying box 2. In essence, they overlap, and in essence, you're doing a retracement on the second box. You're doing an acceptance pullback on the first box, but they come together, and it's kind of a 2-for-1. It's a little bit stronger actually than just having one. So you're kind of getting the best of both worlds there. So again, here's a buying box. Here's another buying box. If you wait for a retracement back to where they overlap, that's that combo or overlap area, should be a very strong area of support. And again, does that work every single time? No, it doesn't work every single time. It is high percentage, but what it also is telling you is that this is an area that really the buyers should hold. And if they don't, and the sellers take this out, that's a pretty good clue this market is having some trouble moving higher and is likely to go test lower. Here's a little bit more aggressive trade, just to kind of give you a feel for this, but this is a breakout trade. So again, you've got the buying box, and whether you were looking for a retracement or not, the market turns around and just breaks out. In other words, rather than waiting for acceptance and a pullback, you have judged and the score would dictate the market is strong enough to just go with it. And that's the idea here. We've got kind of a breakout trade. But you can see that a lot of I say the action is on the edges. A lot of the action is right around the edges of these boxes because those are the key decision points. That's where we really can determine what this market's doing and make sense of. It doesn't mean we're always right, but it does mean that we have a very good handle on the amount of risk we would need. We have a very good handle on how we can tell if we're right or wrong pretty quickly. So same idea here on a selling box. We break out, instead of waiting for the acceptance and the pullback back to the low of the box, we can just go with a breakout type trade. Again, more aggressive, but there are situations where it can make a lot of sense to do that, and we'll talk about that. Now, again, those are some pretty simplistic trades. Hopefully those made sense. I'm not going to get too in-depth in this presentation, but I wanted to kind of tell you about a little bit more advanced trade that you could do. This one would be called a fade trade, okay? So in this case, we have a selling box, and to this point, every time we've had a selling box, you know, I've only talked about ideas of selling. Well, you can have situations where if you have a selling box, rather than looking to, you know, sell a retracement, you might wait for another retest of the selling box's low, and normally you'd be thinking, hey, the market's going down, I might want to sell it. In this case, we would fade it. We would go kind of against the grain here. It's the same idea where, you know, instead of looking to sell, all of the other evidence that we're looking at, the scoring is telling us, hey, we don't want to be short. We want to look for a way to get long. Maybe the low of that box will get rejected and we can just jump on board on an aggressive trade, but a nice, what we call a fade trade. So again, you can get as advanced as you want on this and or as simplistic as you want. I recommend we always start simplistic and then, you know, over time, you know, get into a little bit more advanced trades. But that's the idea here. Now, one quick thing before we start talking about scoring is that, you know, successful traders, I say eat, they don't eat like humans where we have, you know, 3 squares a day or whatever. They eat more like a, you know, a wild animal, a predator, where, you know, a good tiger or an alligator, or whatever the case may be, you know, a tiger can't just run after everything it sees and just run all day long. It's going to get exhausted and it'll end up, you know, going hungry, right? A smart tiger is just going to lay low and wait for an easy meal, and when they have that, they pounce and they have a good meal. When there's not low opportunity, they just lay low and wait. And it's the same thing here when it comes to trading. We don't want to be chasing everything all day long. We want to have the patience to wait for really, you know, good opportunity, and that's the idea here behind this idea of scoring. So the idea here is we've identified trades after we've identified boxes, and we want to determine, do we want to take the trade or do we want to pass on it? Do we want to you know, be aggressive on the trade, or do we want to be conservative on the entry? You know, once we're in, what are our expectations? And this, the scoring here really, you know, helps give you a framework for doing that. And so again, this is not necessarily the, you know, the holy grail. That's not what I mean by any stretch of the imagination. What this is it's a framework. It's a method. It's a way for you to, like I said, methodically understand what you're doing. In other words, is this a good situation? Do I want to get involved right now? What is the opportunity? Okay, how much risk do I legitimately have to take advantage of this opportunity? Is that amount of risk that I would have to take worthy of the quality of this opportunity? It's giving you a framework for doing that. And again, the idea here is that the higher the score, if we get a 7, 8, 9, 10, pretty high edge, it either means there's great opportunity. If you get a 10, for example, that means it's a great opportunity with extremely low risk, okay? You know, an 8 or a 9 might be a great opportunity with a little bit more risk, or it might be a pretty good opportunity with very low risk. But it's always comparing, the idea of the score is it's always comparing the amount of risk you'd have to take relative to the opportunity that exists, okay? And so the higher the score, the better, the higher the expectancy, the better the opportunity, the lower the risk type of a situation that we have. And again, you don't always have to only take 9s and 10s. I mean, there are times where you might consider a 5 or a 6, but mainly if you stick to, you know, 7, 7.5, 8, 9s, and 10s, are you going to win every trade? No, you're not going to win every trade. But if you stick to those trades, you're always putting yourself in a good position where the amount of risk you're taking is definitely reasonable compared to the opportunity that exists in the market. Okay, so again, this is a 10-point system. We're scoring it from 1 to 10, and what makes this up? Well, the first part is the kind of the opportunity side, if you will, the big picture and what I call the now. So in other words, what's going on bigger picture over the last few days, few weeks, and we can give that a score of up to 3 points. And then what's going on just today. So if you're at 10 o'clock Eastern and you're trading the ES, you only have a half an hour of information to make this now score up. If it's 2:30, you've got 5 hours, or whatever the case may be. That's all we're looking at. Now, you can see that the now or the today is weighed slightly higher than the big picture. The big picture matters. They both matter, but we want to give a little bit more weight to what's going on today. That's the most recent activity. Now, over here is up to 3 points on the risk side of things. So in this one, the lower the risk, the higher the score, okay? So, if you're taking on more risk, then that should lower your score. If you have a very low risk trade, that's going to raise your score. Hopefully that makes sense. And again, this is when I just talked about trading, if you really break it down, is being able to determine the quality of an opportunity, then being able to identify and determine how much risk you would have to take, and if that risk that you'd have to take is reasonable, is wise, relative to the quality of the opportunity, you've got a good situation. So that's really what the kind of the gist of this is. And I could talk for an hour or longer about the 10-point idea, but I just wanted to kind of touch on some quick ideas, and hopefully this will make some sense. The first part is, again, that big picture bias. Again, up to 3 points here, okay? So if you look at this score here, we always want to think about it from, are we thinking about a long or are we thinking about a short? And if our big picture bias is up and we're thinking about a long, well, then we would get 3 points for that, for the big picture part. Now, if our big picture bias is up and we're thinking of a short, we'd get 0 points, okay? Same thing, if the big picture bias is down and we're thinking of going long, 0 points for the big picture. And if the big picture is down and we're thinking about going short, then we would have 3 points we would give to the trade, okay? It's the same idea here. Again, here's a buying box, just a basic retracement trade. Let's say the big picture is up, we would get 3 points. Let's say the big picture is down with caution and we're thinking about a long, well, then we would get 1 point, okay? Because down with caution, we'd have 2 points if we were looking at short, we'd have 1 point if we're looking for a long. So if that doesn't make sense, it's pretty simple. It will make sense, but just hopefully that we're trying to understand bigger picture, what's going on. So if we're long or if we're short, are we going with the grain? Are we going with the current of the big picture, or are we going against the current of the big picture? Okay, that's the idea there. Now, the now portion is really the true skill, and there's a lot of components that go into this, but essentially we're asking ourselves, just on the day, are buyers in complete control? Are sellers in complete control? Is neither side in control? Are buyers in more control than sellers? Are sellers in more control than buyers? We're trying to get a relative, grasp on how strong or weak buyers or sellers are. This takes a little bit of time to learn. It's not that it's hard. It's art, and we talk about this. We'll talk about this a lot and how to do this. But being able to get a good handle on your now score at any moment in time, and that can change bar to bar, frankly. But we're trying to get an understanding of the relative strength and weakness of buyers or sellers on the day. So again, you always have to think about it from the perspective of, am I thinking about a long or am I thinking about a short? So if the now score, if buyers are in complete control and I'm thinking about a long trade, well, then my now score for a long would be 4. Well, if buyers are in total control and I'm thinking of a short trade, well, then my now score would be a 0. Okay, and if sellers are more in control than buyers, if buyers are still in play and we're thinking of a short trade, then we get 3 points for a short. If sellers are in more control than buyers, but buyers are at least in play and we're thinking about a long, we would only get 1 point for that long. So hopefully that again, I know I'm going through this quickly, but it's a pretty easy concept once you grasp it. Same thing here on the risk. So many traders mess this up. They either take the same amount of risk based on a dollar amount for every trade, or they take way too much risk than they need, or they take too little risk relative to what they need. We want to really be able to determine where we're actually wrong on any given trade, and then how much risk would that be? Is it then worth it? The lower the risk, the closer we can enter relative to our wrong point, the lower the risk. Okay, hopefully that makes sense as well, and we'll talk about how to define that in the future as well. Let me just give you a couple basic examples using a buying retracement trade, just getting long at the low of a buying box. Okay, in this scenario, if you look in the top left, we're just going to say our big picture bias is up. Okay, that means that if we are looking to get long, and our big picture score would be a 3. Okay, the now score, let's just say the buyers are in total control. So looking to get long, our score would be a 4. Okay, so if we were looking for a retracement, we can see that our stop would be right down here, the red line. Our entry would be right here. It's a very small amount of risk. Therefore, it's a 3 on the risk scale, very low. Okay, now in this case, big picture bias is up. The now score is totally buyer controlled. That gives us a score of 10. That means we have a great opportunity relative to very, very small risk. So we would get a 10 on that particular trade. Now, another way of looking at that is, again, if buyers are in total control big picture and they're in total control today, we have a 3 for the big picture, a 4 for the now, that's a 7 points. You can make the case it makes sense to get in a little bit higher. You don't have to, you're still at a 9, even if you take on more risk on the trade. It's saying that essentially the opportunity is so good, we don't have to wait for the lowest risk trade possible. We can jump on board a little bit earlier. Yes, we're taking a little bit more risk, but the opportunity justifies that risk, okay? So another one, here's an example of, kind of the flip side where let's say we have a selling box, and in this case, again, our big picture bias, let's just say, is up. Buyers are in total control big picture, and let's just say buyers are in total control of the day. Well, what does that mean? Well, if we're looking at a short trade right here, yeah, we can have very small risk. We can have a 3. If here's our entry short and here's our stop, we can have our, a very small amount of dollar risk. So it's a small risk, but we have nothing else going for the trade. Nothing going for us today, nothing going for us big picture. Not a very high percentage trade. Now, can the 3 work? Of course it can work, but if you take 3s all, the rest of your life, you're going to lose money pretty quickly. And that's the idea here. The trade I showed before were 9s and 10s. This is more of a 3. Pretty clear which one, if you took 100 of those is going to make money, and if you took 100 of the 3s, which one's going to lose money. I mean, that's basically the way it works. Let me give you another scenario here. In the top left, let's just assume the big picture is down, okay? And then let's say that on the day, buyers are in total control, okay? So again, big picture is down. On the day, the buyers are in control. So we have a conflict situation, okay? Sellers are in control, bigger picture, buyers are in control today. We do want to go more with the now. We want to go put a little bit more weight on what's going on today. But the only way we could do that, or the only sensible way to do that, is to make sure we mitigate our risk as low as possible. So if we're thinking of long and our big picture is down, well, we get 0 points for this trade. But our now score is 4 because buyers are in total control of the day. Okay, so how do we get this thing over a 7? The only way we could do that is if we take the lowest risk possible. We get in very low in the box, and we have a very small amount of dollar risk, knowing that, yeah, we're going against the big picture grain, but it looks like the evidence on the day is telling us that buyers are really stepping in pretty hard. So let's take a shot at this, but let's make sure our risk is as small as possible, okay? And again, that gets you to a 7. A 7 is going to be a pretty good trade, and hopefully that makes sense. Now let's just say, let me give you another example here really quickly. Let's just say our big picture is neutral, okay? Big picture, we don't know which side's in control. You can make a case that no one's in control. Same thing, let's say on the day, it's just a choppy day, we're in the middle of our range, there's no real box evidence, for example. Let's say that neither side's in control, okay? Now let's say we're thinking about a long trade here. Do we want to do that? Well, our big picture bias for a long would be 1.5, again, because our big picture bias is neutral in this example. And our now score would be a 2, because again, our now score for the day shows that neither side's in control. It's a pretty blah day. So right there, 1.5 plus 2 is 3.5. Even if we take a very small risk, and get a 3, so a very small amount of risk, that brings our total score to a 6.5. 6.5 is not bad. It's better than a coin flip. Do you want to take it? If you're aggressive, you can, but at least you're aware of the condition of the market so that you can mitigate your risk. You can take, you can say, I'm okay with this trade. I think it makes sense, but I sure don't want to risk a lot. I'm going to take as small a risk as possible. I'm going to take as conservative of an entry as possible. Maybe even we'll talk about, lowering our position size, cutting our position size in half. So you can still kind of take a nibble at the market. You just want to do it. You want to know what you're seeing so you know what the smart thing to do, as opposed to when we showed the 9 and the 10. Well, that's when you really want to hit it and probably hit it pretty hard, right? If you can get a 10, well, let's take more contracts on that trade. Let's give it a little bit more time and space. That's the idea here. The framework of this is, again, like I said, this is just the tip of the iceberg on the scoring system as well. This is, you know, just showing a couple really basic examples. You can get extremely detailed with this. It is also, though, I got to say, pretty simple once you grasp what it is, and I hope it did make some decent sense. But the key here, again, the main benefit is that it's giving you a methodology. It's giving you a way to frame the market. It's giving you a way to determine what is, to me, the key question with every trade, which is, what is my risk? What is my true risk? Not just, you know, am I going to risk X dollars? What's my true risk? Where am I really wrong? Okay, now, how good is the opportunity? You know, the big picture score, the now score is telling us how good the opportunity is. And then if I can get a situation where the amount of risk I would have to take is justified relative to that quality of the opportunity, I've got a good situation. And that's what the scoring system does. Again, it's no holy grail. It's just giving you that framework to really make sense of the key of trading, which is opportunity versus risk. That's really all it is. If you always get yourself in situations where the risk is justified relative to the quality of the opportunity, you are a successful trader. There's just no way around it. It's kind of a natural law of trading. So I got a few minutes here for any questions. You can type them into the question box. I do want to say that, you know, what I will be offering here very, very shortly is basically you know, everything that I've talked about there, a complete methodology, all of the steps, A to Z that we talked about, thorough instruction, and then live market education, generally speaking 4 days a week. Some days it'll be 3, some days it'll be 5, but generally speaking 4 days a week. They'll all be recorded, a lot of interactive back and forth, you know, coaching, full access to our software, full support, you know, just a really thorough program. It's going to be the same idea that I've done with one-on-one coaching at a lot different price point. So what I would recommend is, if this was intriguing to you at all, please send me an email at info@daytradethemarkets.com. I'm going to send you a special offer, a really incredible deal. Again, if you're not interested, that's fine. But if you are at all interested, it's not quite ready for sale. But if you send me an email, I will definitely let you know of a really good introductory offer here, and you can join up. So I'm not going to try to sell you on it, but that's, again, if this was at all intriguing to you, I would definitely recommend shooting me an email, and I can let you know a little bit more about it as it launches. So Maggie is asking, does your software draw the boxes, or can they be drawn manually? What I recommend doing is drawing them manually, because you know, at first when I teach it, it's, you know, you want to follow the rule black and white, okay? But there will be about 10% of the time where you want to overrule that black and white, you know, box drawing rule. That just takes a little experience, but that's why I recommend, you know, doing it manually, because, again, start off and maybe do it forever. Just be black and white with the rule. There is a very black and white rule for drawing a box, and you can do it that way. But you might find, as you gain more experience, that you can do 10% of the time, you can actually make the box a little bit better, and I think that's what the manual drawing of the box gives you. So hopefully that makes sense, Maggie. Let's see. If there are any other questions, go ahead and send them. I know, I mean, I went through a ton of slides there, and I threw a lot at you. I will have a recording that I can send out, and you can, you know, pause it and look at a little more in depth. Plus, I will be adding, changing the website here in a few days, and adding a lot of different videos and information about this as well. So again, I know I did throw a lot of information at you pretty quickly, but hopefully it you know, it made sense. The idea of, let me see if I can go to a slide that makes sense. You know, the idea here again is we're using true aggression true aggression understanding of the market to help us determine what makes, you know, when the market's doing something, when it's not. That helps us draw these boxes. That frames the market. Within the boxes, we come up with trade setups. Once we have a trade setup, we score the setup, and that's kind of the process that you go through. And not even talking about the exit side of it yet, but just on the entry side of it, that's the process that you'll go through there. Let's see, question here, what markets do you trade? I personally trade the ES, the E-mini S&P, and crude oil mainly. That's me personally. You do not have to be limited to those two markets. That's just what I like. I look at gold a bit, but you can trade any liquid market. The same principles apply. Jerry is asking, missed a portion due to weather. How do your boxes compare to Darvis boxes? I remember. Oops. Oh, I'm sorry. What did I do here? Well, I lost the slide. I apologize. Sorry about that. Can you guys still see that? I hope. Okay. So, oh, here we go. I guess we'll do it this way. Again, if you're interested at all about this, just send me an email. Question from Jerry: how do these compare to Darvis boxes? I remember reading the Darvis box books, a book where he would like travel the world. This was probably 10, 15 years ago. I'm sure there is some overlap. It's not the same thing, but I'm sure there is some similar nature, but it's not the same thing. Let's see. Thanks to you and Randy for the presentation. Not to give up your secret sauce with the aggression bars, but does the algorithm entail defining where unfilled orders may exist? Might be an odd question, hard to explain in chat format. It's to a degree. I mean, if you look at any like footprint type chart, we're taking some of that information. You can see that on like a footprint chart. Now, what I have found when I look at those is personally, and I've heard from a lot of people as well, that you get so fixated on bar by bar, tick by tick, that you lose sight of what really matters, and you just get you don't. It just makes it harder to make sense. What this is taking a lot of that same information. So we're looking at a lot of bid-ask stuff, just like you're talking about. We're making a lot easier to see with just the aggression bars alone. Then when you add on the idea of the boxes and the trade setups and the scoring, it's kind of taking that idea and going a lot more depth. Now, do you have to use the boxes and the trade setups and the scoring exactly like I'm going to teach it? No, you don't have to do that. You can just use it as a tool and integrate it with what you've already got. In fact, that's probably a great thing for many people, and I would recommend using the boxes to say, hey, this looks like a good spot. I know buyers are taking over. This looks like a great spot to be a buyer. Does one of my other setups with a different type of chart show a setup in this zone? Well, it just gives you a little bit extra confidence, if you will. So let's see. I don't know if that made sense, Jim, or not. Don, what time frame do you primarily use? I personally use a 1 minute chart mainly. You can use this on essentially any time frame you want. What I have found with the 1 minute chart is it's quick enough that I can jump on things early, but with the software, I don't get the downside of like a 1 minute chart, which is typically a lot of noise, because the software itself is telling me where I need to pay attention and what I need to pay attention to. So it's not so much a, so to me, the 1 minute's kind of the best of both worlds. You can use it on any time frame that you want, depending on, your style. Let's see. Erica, what does the software do drawing the boxes? No, the software, we start with the idea of the aggression bars, and that then leads to, so the aggression bars are helping you see under the surface of the market a lot more clearly. Okay, that's what we've basically worked with traders and offered the software that basically is the aggression bars, just to help them make better decisions with that alone over the past 3 to 4 or 5 years, whatever. Oh, gosh, I guess it's been like 6 years now, and that's been a great tool. We have a lot of really happy people that say that they wouldn't trade without it. I feel the same way. So the software is kind of looking under the surface to show you when buyers or when sellers are more aggressive. That's the first part. The second part then is you can utilize those if you want, and this is what I'll be teaching, to create boxes. The boxes frame kind of give you a smaller playing field to try to make trading decisions throughout. Within those boxes we have trade setups, and you can score those trade setups. So it all kind of works together as a cohesive unit, Erica. Hopefully that made sense. Let's see. I think I've gotten the questions. If there are other questions, let me know. right now. I've got we could stay on for another minute or two here. But otherwise, what I would highly recommend is that if you are interested in, if this was intriguing to you at all, like I said, I've taught this in 2016. This is a method I've personally used for a few years now, and then I taught this specific way of using our software to a few people in 2016 in one-on-one coaching in a pretty intense program. It went, the feedback was great. People were feeling that they could see the market a lot more clearly than ever before and could make better decisions and so forth. And so that's what, I'm going to be teaching the exact same thing. It's been very, very successful. So if this is at all intriguing to you, just shoot me an email and I'll send you a special offer when it's ready to go. But otherwise, you can also then, if you have other questions as well, just send an email to info@daytradethemarkets.com. So hopefully that makes sense. If there are other questions, go ahead and send them on email. And otherwise, I really, really want to thank everyone for attending today. Thank you for the questions. I hope it made sense, and would love to work with you. I think I think honestly, you'll be blown away. So if you have any other questions, shoot us an email. And otherwise, thank you very, very much. And hopefully we'll talk soon. Thanks.